Law firm owners, there are only a few ways to lose your license without meaning to. Messing up your trust account is one of them. Today's confession is about a firm that was 6 months behind on reconciliation and didn't realize they were sitting on a time bomb. Before we get into it, quick disclaimer, the names, firms, and exact numbers have been changed to protect the innocent and the stressed. But the IOLTA nightmares, those are very real. Let's set the stage. Picture a two-attorney estate planning law firm doing about $600K a year. Bob and Karen are busy. Good reputation, steady growth. Everything seems great except for one thing. The trust account hasn't been reconciled in 6 months. Everyone assumes someone else is handling it, and there isn't that much moving through it. So what's the big deal, right? Plus, there's just a lot more pressing work to do. Then, on that random Tuesday morning, everything changes. In between client meetings, Bob grabs the mail just like he always does. But this time, there's something in it he's not used to seeing. Something no attorney wants to see. It's a letter from the state bar, addressed to him. He opens it, and the words on the page hit him like a ton of bricks. You've been randomly selected for an audit of your trust account. His stomach drops. The letter gives him 30 days to provide a certified statement with the math showing the trust account is reconciled and in good standing. He's not sure where to start, so he does what a lot of lawyers do when out of their depth. He opens Google. It doesn't take long to figure out what to do. Step 1, match the bank statement balance with the law firm ledger balance. Step 2, match the client ledgers to the law firm ledger. And step 3, check for red flags. It sounds simple enough to Bob, so he gets to work. First step, matching the bank balance to the law firm ledger balance. He figures it's probably matched up, so he looks at the latest bank statement and the last law firm ledger balance. They're off by exactly $3,491.38. Why can't it be a round number, he thinks. At this point, he knows it's both too much work and too far outside of his area of expertise, and he gets some help. He called us. Here's what we did. First, we started with the oldest month not reconciled and then went forward. Second, we compared the bank balance with the law firm ledger, taking into account outstanding checks and deposits that had not yet cleared but had been entered into the ledger. And third, we compared the law firm ledger to the client ledger to ensure there were no gaps. And at the same time, we also checked for red flags, negative client trust balances and ghost balances. 2.5 weeks later, we had a clean, documented 3-way reconciliation across those 6 months. Bob was able to sign and send in the certification to the bar with actual confidence and not hope. And we had a new monthly client who now sleeps a lot better. If this sounds even a little familiar, don't wait for a letter like that to show up before taking action. 3 quick checks you can do this week. Number 1, does your trust ledger equal your trust bank balance? Number 2, are you getting true 3-way trust reconciliation every month? And number 3, are there any negative client balances in your ledger? If you can't answer those, you're not just behind on bookkeeping, you're quietly betting your license on hope. Whew, that was heavy. Let's move on. Something a little bit lighter. It's mailbag time.
Mailbag.
Welcome to the Big Bird Mailbag, where I answer real questions from law firm owners about their books, their trust accounts, and saving on taxes. If you have a question you want answered on the show, leave a comment and I'll work it in. Okay, question number 1. John from Texas asks, should I link my Clio/MyCase/Smokeball directly to QuickBooks Online, or is it safer to keep them completely air-gapped? This is a great question, and the answer really is, it depends. If you're going to invoice through QuickBooks for your law firm, clients or whatever, then I would probably have them linked up. If not, then I would not link them up at all. Okay, if you're going to invoice separately through Clio or MyCase or whatever, just leave them unhooked. Here's why. When we're doing people's books, when we're doing law firm owners' books, we don't necessarily care about the individual invoices. We don't care necessarily about the accounts receivable. You can print out a report from Clio, from Smokeball, to see what those accounts receivable looks like. What we care about is income that's coming in and expenses that are going out. For that information, we need access through QuickBooks to your bank accounts, to your credit card accounts. We need loan statements and things like that. We don't necessarily need to know if, Fred Smith paid his invoice for the month. So I would say leave them unhooked unless you are doing that invoicing through QuickBooks. Then you want to have them hooked up because they just need to talk to each other. Don't hook them up though. That's my recommendation. All right, great. Okay, good question. Question number 2. Cindy from Florida asks, am I overpaying I'm being quoted $500 a month for basic bookkeeping for a solo firm. Is that normal? Okay, Cindy, you're on the edge. Honestly, we don't charge that much for a solo firm. If you need trust accounting, we might be probably in the $395 to $495 a month range. So you're not getting just absolutely taken advantage of. However, you're probably on the higher side. It kind of depends on how many transactions you're doing. It depends on the kind of work that you need done. But, I would say if you're not doing any trust account reconciliation, I probably would look closer to like the $395 a month range and maybe even a little bit lower than that. The truth is, if you have a good bookkeeper that has good systems, that has good operations, that utilizes a good platform, we can really get a lot done pretty quickly and efficiently. And that savings, that efficiency should be passed on to the client, in my opinion. That's why our fees are a little bit lower, I think, on average than what you might find out there otherwise. Great question, though, Cindy. Okay, question number 3. Mark from Cincinnati asks, how do I handle bank fees on my IOLTA account without commingling my own funds? Great question, another good question. And something that a lot of people are really nervous about, not sure what to do, and kind of scared all at the same time. So here's the simplest solution. This is probably where I would start. We're talking about bank fees only, okay? We'll talk about how do you handle sort of like credit card processing fees in a different question. This is literally, you have an IOLTA account. Let's say it charges you $10 a month to run the account. Obviously, you don't want that $10 to be taken out of client funds because it's not a client expense, and we want to do it right. Here's the easiest thing to do. You are allowed, through your bar rules, to put some of your own money into the trust account, so long as it is specifically earmarked and allocated for these type of bank charges. All right. The way that you do it is relatively straightforward. You're going to create a trust ledger, client ledger for yourself. You're going to call it, sort of firm bank funds. And you might put $100 in there. You might put $200 in there. And then when you have these bank fees that come every month, you will just allocate that expense to your own sort of client ledger, again, in parentheses. That way, you're never using client funds for those business expenses. You're accounting for them very specifically and very clearly, and you're operating within the bar rules, which is what we want. Okay? Great question. All right, that's the Big Bird mailbag for this week. Up next is everyone's favorite part of the show, Big Bird's Tax Corner, where we help you keep more of what you earn by lowering your taxes. Cue the graphic. Welcome to Big Bird's Tax Corner, where small law firm owners learn how to legally pay less in taxes. Today's topic is, can I deduct my suits as a business expense? Okay, this is a classic question. When you guys may not know this, but I'm a lawyer. I own a law firm as well. Part of the reason why I started Big Bird. But back in the day, I used to wear a suit to work every day. And I tried my darndest to be able to write off all of the suits that I bought. And I would go, buy like 3 or 4 at a time. I'd wear them for the whole year, then I'd go buy some more. I searched and searched and searched, and I thought to myself, I can write it off as maybe a marketing expense. It's a uniform. There's definitely something in the tax code about uniforms. But alas, you are not allowed to write off your law firm work clothes as just business expenses. There's no uniform rule that it fits into. It's not a marketing expense, so I'll tell you maybe how you can do that in a minute. So the general answer is no, you cannot write off your law firm clothes as a work expense. Okay? Now, what about the uniform thing? The uniform write-off that the IRS allows for is like specific utilitarian needs for specific industries. If you are a construction worker and you have to wear a hard hat, you can write that off. If you are a police officer and you have to buy your uniform, you can write that off. If you're a construction worker and you need steel-toed boots, you can do that. But wearing a suit doesn't qualify, unfortunately. Okay, so that's a no. How can we write off our suits or our lawyerly wear as a marketing expense? Now you might think to yourself, I'll just put a logo on my suit, and that's great. That's probably not going to qualify either. Here's why: because you're not giving it away to anybody. Most of the time, that marketing swag t-shirts, hats, you make it to be distributed to other people. That's what makes it a marketing expense. I guess maybe if you put a huge logo on your student ward around, it could be kind of like wrapping your car, but who really wants to do that, right? So one way though, again, to sort of close the loop on this, to write off your clothing as a business expense would be to just create a bunch of swag and then wear, that stuff to work every day. If I put a logo on my crew shirt here and I wore this to work every day and I had something to give away, I could probably write that off as a marketing expense. That would work. So keep that in mind. But generally, the answer is no. You can't write your shoes off. You can't write your Gucci shoes off. You can't write off your red bottom heels. That's definitely not going to qualify. So sorry to be the bearer of bad news, but that's kind of what we do here sometimes at tax time, is save you from getting smoked if you get audited. Okay, hope this helped. If it did, that's great. That's it for tax time. Real quick, if you're a law firm owner doing between $300K and $1 million a year, and you're not confident your books and trust account would survive an audit, I'm offering a free trust and books checkup for your firm. We'll review your setup, flag any real risks, and outline a cleanup plan. To book yours, go to bigbirdaccounting.com/checkup.